All right, welcome back, ladies and gentlemen. Let's get straight into this video, you guys. Today, we're going to be going over how to pretty much use ICT concepts to, make profitable trades, and also how to, use those concepts to pass a prop firm challenge. But before we get into this video, you guys have to do a quick government risk disclaimer. The information that you're going to receive in this video is not intended for financial advice, right? I am not a financial advisor. The information that you're going to receive in this video is purely for entertainment and educational purposes only, you guys. So let's get straight into this video. All right, so we're going to be taking a look at the NASDAQ E-mini chart, you guys. First thing I'm going to do is I'm going to clear as much off of my chart as possible. You see, I gotta go here. So let's go to high draws, right? I want to give you guys a blank chart. So typically, you guys, using ICT concepts are great, right? And I understand if you're a beginner ICT student, you first learn what a fair value gap is. You see them everywhere, right? You see these fair value gaps everywhere. They're pretty exciting. They're pretty cool. Sometimes they work, sometimes they don't, right? One of the most important things you have to understand is daily bias and liquidity, right? Daily bias and liquidity pretty much trumps everything else, right? Now, the reason why I say that, I'm not saying that fair value gaps don't work. I'm not saying that breaker blocks and everything else don't work. But what I'm pretty much saying is that you have to understand those two things before you understand anything else, right? And I'm going to give you guys a perfect example of why, right? So, also, sometimes, candlestick patterns are important as well, because look at this big bearish engulfing, right? So we have a big bearish engulfing on the weekly time frame, right? So right here, all right, crap, let me see something. Just wanted to see something. All right, and this is also why it's important to check these higher time frames, right? I just wanted to box that little weekly zone up real fast to see something really fast, you guys. Just give me 2 seconds. I have a lot on my chart, and I just erased all of my drawings so I can show you guys a blank chart. But what I'm going to do is I'm going to just delete this off, right? And then I just want to see something, right? Because we have a bearish engulfing right here. So we did not hit the midpoint of that just yet. So price could want to retrace back up in there, right? Price could want to retrace back up in there. So let me take these drawings off of my chart. I got a little distracted, you guys. Just bear with me in this video. This is going to be a really good video, especially, if you're a beginner or even if you're an experienced trader and you're still struggling. This is going to be a really good video for you, right? So let's just go back to a bear chart, and I want to talk about daily bias, right? But also, like I said, looking at the weekly is going to be so important, because the weekly obviously trumps it trumps the daily chart. All right, so when we got that big pullback last Friday, most people were surprised about it, and that's probably because they don't look at the weekly chart. We had this big wick right here. You guys know I have videos out about wicks, but pretty much this is the midpoint of this wick is where this candle came and dropped into, right? If you guys go to your weekly chart on your E-mini NASDAQ futures, you guys can see exactly what I'm talking about, right? Now we're going to drop into the daily time frame, right? Because this is what I also want to talk about. Because I'm going to show you guys a trade that pretty much, you could have got a 1 to 10 risk to reward ratio on this trade. Now, this video is not intended to just be you guys should only be trying to take 1 to 10 or 1 to 5s or crazy risk to rewards. But this video is intended to show you guys how you can do that using ICT concepts, right? Okay, so notice this is a daily chart. So first thing we want to look at when we're looking at the daily chart is the daily high and the low, right? So each one of these candles makes 1 day of price action. This wick is the high of where that price went on that day, and this bottom wick down here is the low of where the price went, right? the bodies tell you where the price opens and closes. So if this candle is red, that means it opened at the top of this body and it closed at the bottom of this body. Vice versa, if this candle is green, it means it opened down here at the bottom of the body of the candle and closed at the top of the body, right? And these lines are wicks, right? These lines are wicks. So what I want you guys to notice is this, right? Let's look at the past like 3 or 4 days. So you guys can see we broke out the bottom, and then we broke out the top, right? This red candle right here broke out the bottom, then we broke out the top. Then we have this green candle right here that couldn't break out the bottom, but it broke out the top, right? Then we had this candle that broke out the top first and then broke out the bottom, right? And so why is that important? Well, because we had this big market structure shift on the daily time frame, right? And overall, I'm still bullish because, like I said, if you go to the weekly, it's still very bullish. But when you have a market structure shift on a daily, typically you can anticipate that for at least the next, 5 days, right? Maybe even 2 weeks worth of, daily candles, you're going to see some type of pullback and liquidity be swept on these time frames, right? So now I'm going to show you guys some of the things that I have on my chart and how I like to use ICT concepts. All right, so let's go to show all, right? I'm going to try to delete as much as possible if I don't need it, because I could always just add it back later. So these purple boxes on my chart, you guys, these are new week opening gaps. And that is mostly the only thing I like to keep on my chart because, like I said, you guys, it's easy for people to, forget about the weekly time frame. And then, when the price comes and bounce, when price really starts to move, like last Friday, when this price was moving down, I was able to really catch some good trades because I was just using a new week opening gap, right? So that's one of the reasons why I like to have new week opening gaps on my chart. I do also keep new day opening gaps on my chart. But let's get into yesterday's price action, right? Which was yesterday was October the 16th, right? October the 16th, right? So let's get into yesterday's price action. We're going to first go into the hourly chart, right? Because I have this boxed up because I was actually looking at this trade live, right? So on a daily, like I said, we had on a daily time frame, we had price coming down here, swept this liquidity, right? Then what are we going to typically do after we sweep liquidity? We're going to come back, sweep liquidity on the other side. And because we're bearish, right, typically what you're going to see when the market is like bearish on a daily or a lower time frame, you're going to see the market build out liquidity, right? So before it makes a really big dump, it's going to just build out liquidity, right? Just like over here. I'll give you an example. Just like over here, look at how many lows it made before it made this big dump, right? 1, 2, 3, 4, 5 significant lows, 6 significant lows before we made this big dump over here. Okay, so let's get into today's price action, right? So what we had at 9 a.m., right? Let's just try to go into maybe the 15-minute time frame. I'm trying to pick a good time frame. So I'm going to put a vertical line on the 9:30 opening candle, right? So typically what I do, there's a few things that I use with my strategy. I use the first presented fair value gap, not particularly to take entries, but mostly, just to read price. Sometimes I do take entries using it, but mostly to read price, you guys. So what did we have in here? Let me see. So we had our first presented fair value gap, which is about right here. This is our first presented fair value gap. So what I would do is I would box this up, right? That's this little gap right here. The first presented fair value gap is simply the first fair value gap that happens after 931. You guys, after 931, it's never the opening candle. So like this candle right here that opened at 930, it did create a gap, but this would not be our first presented fair value gap. It's everything after 931, so this will be our fair value gap. So as you guys can see, today, price really wasn't respecting the first presented fair value gap that much, right? So that's why sometimes it's not really easy to just take buys off of it. But typically, what I do when the market isn't really respecting it, like when it's doing all of this choppiness around the first presented fair value gap, what I like to do is just sit on my hands and do nothing, right? So I'm going to show you guys what I was looking at today, right? First, we had on a 2-hour time frame, right? On a 2-hour time frame, first we had, I'll have to move this back just a little bit. On a 2-hour time frame, we had a bearish engulfing candle. Now, simply put, you guys, what a bearish engulfing candle is, it's when this candle right here on the right side, right? It's a 2-candle pattern. So it's when this candle breaks out the top and the bottom and it closes like this, right? And it looks red, right? It looks like it wants to go down, right? So that was my first indicator that the market wanted to go back down. I did take this trade. I was in some profits and eventually I got stopped out, all right? But I was confident that, we was still going to want to drop down, especially because we had a 5-minute fair value gap. Right, we had a 5-minute fair value gap, and this right here was a stop loss for that fair value gap. So we never hit that stop loss, which means what? That this fair value gap is still valid, right? This fair value gap is still valid. So if we drop down into the 1-minute time frame, right? If we drop down into the 1-minute time frame, okay? So what are you going to see? After we pull all the way up here, you're going to see a breakdown, right? This right here is a breakaway gap. This right here is a breakaway gap. So when I'm using breakaway gaps, sometimes it's hard to tell what's a valid breakaway gap because the market likes to fake people out on breakaway gaps all the time. So one of the best things you can do is just wait, right? Wait to see if the market is going to pull back into it, right? So as you guys can see, when we broke away, the market tried to pull back up. It could never get back into this gap. It tried it again, could never get back into this gap. So what I like to do is put my stop loss right here, right? Because I can trust that the market is not going to come back here, right? I can trust that the market is. If you don't trust the breakaway gap, you could also use this as an inversion fair value gap right here. And the reason why I'm using the bottom fair value gap is because that's the one that would have been in a discount zone, right? If we would have used, swing low to swing high on a 1-minute, this is the fair value gap that's in a discount zone. So I'm going to use that for my inversion. So as you guys, if you don't want to trust the breakaway gap, you can put your stop loss up here. When the price breaks below and retest the midpoint of this inversion, you can take that trade and have your stop loss up here, right? But I'm going to show you guys, how I would have done it. Either way is fine, because even if you get in all the way down here, I'm going to show you guys why, right? So don't forget about the daily time frame, right? This whole video is about understanding the daily bias and then understanding liquidity, right? So understand, after we swept this liquidity on a daily time frame, right? We went up here, we took out this daily high, right? Where are we going to likely target next? Well, bare minimum, we're going to likely target this daily low, right, from yesterday. We took out the high, we're likely to come down and take out the low. And if we was really going to, if price was really going to be moving bearish and really fast, we could have taken out this low as well, right? And this low is going to likely be a target for today, right? This low right here is going to likely be a target for today. Notice how we took out this swing low down here, and then this daily candle wicked above, right? It wicked all the way back up. So before we can say that, we're going to take out this low, we have to see how price is going to respect this wick. I'm just giving y'all an extra gem right here, right? Extra jump. So what I like to do is I like to measure out this wick, and I'm going to want to see, is price going to want to hold this up all night, right? Because what happens during the London session is like, in these type of conditions, price will hold this all night, but you get a retracement back up. Then during the New York session, that it'll be like the power of three. You know, it'll be like accumulation, right? You get a consolidation and then manipulation. During New York Open, price goes up, and then you get the fall off, right, back down to liquidity, right? And that's why understanding liquidity is so important. But I had to give y'all that quick jump right there because that's important to understand. Daily bias and liquidity, right? So our daily bias is obviously going to be what? Sales, right? We're looking for sales. Why? Because we had a market structure shift. We got this big, fair value gap on the daily time frame. We got liquidity resting up here. Once we take that liquidity out, we're looking for liquidity down here, right? Because the market is pulling back on the daily time frame. So let's go back to the 1 minute, right? I just had to bring everything into context for you guys so y'all don't get too lost in this video, because I'm trying to give y'all a lot of gems at one time, right? So what I like to do is I like to use the lower time frames with the higher time frames, right? This is how you can really get really good risk to reward. So even if you don't have a perfect entry, right? Let's say you get in all the way down here, right? Let's say, you had to wait for this, right? You had to make sure this breakaway gap was valid. So you didn't get that entry, but then let's say you got in all the way down here, and then you put your stop loss right there where I would have had it, right? And let's just say you get in right there. Now we're going to switch back to the daily time frame. This box is so small you can't even see it on the day. Okay, there we go. And then we're going to drag this box all the way down. Where is it at? We're going to drag that box all the way down to this daily low. Right? So that will be your target. Now, what I would like to do is, right, and what I actually, did do is we're going to drop it to the 4 hour, right? Because I just want to show you guys something. So as you guys can see, this is a 1 to 8 risk to reward. Now, we did have a 4 hour wick right here. I would have put my, target in the middle of this wick first. And the reason being is because of this, right? Just want to show y'all that we don't really need this box, but I would have put my target. So it really would have been like maybe a 1 of 4, 1 of 5, 1 of 6, something like that, right? But I mean, just think about it. This is how you can pass a prop firm challenge with no problem. Now, these moves don't happen all the time, and they are hard to catch sometimes. But once you get good at it, this is what you pretty much want to get good at if you're going to really start working towards, having consistency in your trading. So me personally, I would have targeted like the midpoint of this wick, and I'm going to show you guys why. All right. Now, even though the market did hit its target, you guys, the market did hit its target, but once it got to the midpoint of that wick on the 4 hour chart, and y'all can go check this out for yourself, this market bounced 200 points, right? 200 points before finally dropping back down to give you your target, right? So if you would have just got out right here at 730, I mean, from 730 to this low down here, that's only literally 30 points. Don't be the guy that's so anal about your take profit that you sit through this 200 point pullback just to get an extra 30 points. Don't be that guy, because sometimes what the market will do is it will pull back and then just keep going, right? Luckily, we knew where our liquidity was at, so you could have scaled a lot off. If you wanted to just be the guy that want to practice on holding for a take profit, you could have scaled off like 80% of your trade, and then let the rest come back down, right? Or you could scale off the whole 100 and then try to get back in up here, right? I deleted it off of my chart, but there was a first presented fair value gap from, like, I think it was either from the 15th or the 14th. I was right up in here as well, but I took it off of my chart. All right, so I do use the first presented fair value gap, And I use it not only for the morning session, but I also use it for the evening session, right? So the first presented fair value gap after 1:31, and then I also use the first presented fair value gap after midnight, right? So like, for example, um, our midnight opening candle, right? I always like to look at the midnight opening candle, right? So we got the midnight opening candle right there. So what I do is this: I put a line on here, and I don't keep them on my chart for too long. I like to like maybe keep them on there for a day or two, but because the price typically refers to this level all throughout the week, right? So I like to keep it on there, but not for too long, because you know the main thing is about understanding daily bias and liquidity. So I'm gonna put that midnight open. Then we're gonna lock this up. All right, and then right here from our first presented fair value gap after the midnight opening, it looks pretty choppy in here. So I'm not even gonna really, me personally, I would say is this one because this one is more significant, but this is choppy. I'm just gonna use the midnight opening, right? So um So that's pretty much how you get a really good risk to reward on these trades, you guys. But stop loss placement is going to be really important because, yes, if you're new to ICT, you're probably wondering why not just, do what ICT tell me to do, take the daily fair value gap, put my stop loss all the way up here. Well, from here to here, that's a 200-point stop loss. So even if you do that, it's nothing wrong with doing that because you see how much the market dropped, right? So you would still, at the bare minimum, get like a good 2-to-1 risk to reward, right? So it's nothing wrong with doing that, right? That more times than not, that's going to be the more safer option, anyways. To be honest with you guys, but I'm just trying to show you guys how to get a better risk to rewards using the higher and the lower time frames. So if this video was informational to you guys, make sure y'all drop a like, subscribe to the channel, so I can be inspired to do more videos like this. And if you guys want me to continue to talk more about how I trade and what I look for, let me know in the comments below, you guys. I appreciate you guys for watching this video, and I will see y'all in the next one. Peace out.